In this video, we will explore about strengths, weaknesses, opportunities and threats analysis, commonly known as SWOT analysis. This is a fundamental tool used to evaluate where a company stands in the current market landscape. We will look at how to break down a business to see its true potential and the risks it faces. The business world is never static because the external environment is constantly changing. These changes bring two things. First, they bring opportunities, and second, they bring threats or challenges. When a new opportunity appears, companies that are well positioned can seize it and prosper. However, when a threat emerges, only companies with strong fundamentals can survive. Vulnerable companies often perish. A great example of this is the COVID-19 pandemic. It was a major disruption. Companies with weak financial positions struggled or shut down, while those with strong balance sheets managed to survive the lockdown. Understanding this dynamic helps you evaluate a company's growth potential and its risk tolerance. To make sense of these factors, we use the SWOT framework. Imagine a simple grid. On one side, we look at factors that are internal to the company. These are strengths and weaknesses. On the other side, we look at factors that are external, meaning they come from the outside environment. These are opportunities and threats. We also divide them into things that are positive or helpful, like strengths and opportunities, and things that are negative or harmful, like weaknesses and threats. This framework gives us a structured way to evaluate the business fundamentals. Now, there are two ways to approach this analysis. The first is the corporate strategy approach, where you identify internal strengths and weaknesses first and then find external matches. This is great for company managers. However, as an investor or analyst, you should use the analyst approach. Here, you study the external conditions first, the opportunities and threats, and then look at the company to see if it has the capability to handle them. This aligns perfectly with the logical flow of economy, industry, and company analysis, where we start big and narrow down. Let's start by looking at strengths. These are the internal capabilities that allow a company to grab opportunities and fight off threats. When you analyze a company, look for things like a strong financial position or highly valuable intellectual properties like patents. You also want to see low customer concentration, meaning they don't rely on just one or two clients. Other key strengths include having a low cost structure, which leads to high margins, support from a strong parent company or the government, and a solid track record of execution. On the flip side, we have weaknesses. These are internal issues that create vulnerability. You need to look for warning signs. A weak financial position is a major red flag. High fixed costs are also dangerous because they eat up cash even when sales are down. Low margins are risky because they can easily turn into losses during a slowdown. Other weaknesses include high customer concentration, significant legal cases that could cause losses or distract management, and a lack of experience in executing new strategies. However, not every weakness is equally important. You must apply a filter of relevance and context. For example, imagine an automobile company lacks experience in self-driving cars. This is a potential weakness. But you must ask if there are industry catalysts driving demand for self-driving cars right now. If the future growth is self-driving, then this is a material weakness. But if there is no foreseeable opportunity in that space, it is not immediately relevant. Similarly, a decline in revenue is only a critical weakness if it stops the company from getting new business or loans. You must also be aware of your limitations as an analyst. Think of a company like an iceberg. As an outsider, you can only see what is above the water. This includes public financials and disclosed frameworks. But there is a massive part hidden underwater that is hard to identify. For instance, a company will never tell you about their secret political clout or lobbying strength. Worse, if they are using creative accounting to hide fraud, it is very difficult for an outsider to spot it until it is too late. Now let us move to the external side, starting with opportunities. These are created by events in the environment that act as inflection points. When these events happen, they can trigger accelerated growth. For example, the arrival of new battery technology created a massive opportunity for the electric vehicle industry. Another example is the global supply chain shift after COVID-19. As companies look to move manufacturing out of China, it created a growth opportunity for manufacturing sectors in other countries. Opportunities often come from regulations and geography. Changes in laws can open new doors. When the Companies Act 2013 was passed, it created a huge opportunity for consulting firms to help businesses comply. The Y2K problem in the late 90s was a massive opportunity for Indian IT firms. Today, ESG compliance is a similar emerging field. Geography also plays a role. Changes in capital control regulations can suddenly allow a company to expand into a territory that was previously out of bounds. Adverse market conditions can also be an opportunity specifically for consolidation. When the economy is tough, strong players get stronger. For instance, when Jet Airways exited the market in April 2019, it transferred market share to its competitors. Similarly, during a recession, share prices and interest rates are low. This gives cash-rich companies a golden opportunity to acquire their weaker rivals and grow their dominance. Finally, we have threats. It is crucial to distinguish between a threat and a weakness. Remember, a weakness is internal, like high customer concentration. A threat is an external risk. A classic example is an economic recession. The company did not cause the recession, but it has to deal with it. Knowing the difference helps you understand what the management can control versus what they must simply weather. Threats can come from many sources. We have economic threats like a recession that lowers demand. We have regulatory threats such as a government ban on single-use plastics, which creates strong headwinds for plastic manufacturers. We have technological threats like artificial intelligence disrupting the BPO industry, and we have deregulation threats. For example, if the central bank starts handing out more banking licenses, it removes entry barriers and increases competition for existing banks. When you are listing threats, you might be tempted to list everything that could possibly go wrong. Do not do that. You need to filter based on probability versus possibility. While it is true that a black swan event like COVID-19 can happen, listing every remote possibility makes your analysis unusable. Instead, focus on the threats that have a reasonable probability of occurring. This ensures your analysis remains actionable and useful for making investment decisions.